The last step in the analytical process that I suggest is to take a look at the capital structure. When we look at capital structure, it's the mix of the debt and the equity that the company uses to finance its long-term obligations. It shouldn't be a short-term thing. It's the long-term capital to give it a stability. Okay? And each company actually has an optimal amount of capital for their business. It depends on the amount of assets used, the liabilities, the speed of the working capital, the growth that's needed. So each one is unique. When we look at this from a risk perspective, is as an investor, whether that be debt or equity, the lowest risk is senior secured debt, that you have a bond, you have something, an asset that you can look to if the cash flow doesn't pay it. We then move all the way to equity. There's deposit, senior secured debt, subordinated debt, hybrids. These can be preferred stock or convertible notes that are debt-like, okay, that have a fixed coupon or payment associated with them. But again, they have some components or opportunities to convert into equity. And when we look at senior debt, all that means is that it's above the subordinated debt. Subordinated debt is that debt which comes after senior debt. And there's a cost associated with each one of these. And the most secure one with the lowest risk has the lowest price. We move up to equity, it has a higher cost. So if we're looking at this in sort of a liquidation mode, and that's to a degree what we're finding with COVID-19, is that if you have assets after you say you are going out of business or bankruptcy, these would be paid first, and whatever left goes to equity. Saying that in reverse, the losses are first applied here and work their way up. So that's what capital structure is, but that has us going back to what leverage is, which we talk about in 311. Now, leverage is how a firm uses debt or finance leverage, that it's borrowing money. If the firm earns more on its asset than it's paying on its debt, then using debt leverages or magnifies the return on equity. By using debt, stockholders can control the firm with a limited amount of equity. Creditors, on the other hand, look to equity to provide a margin of safety in uncertain times, just like we have today. And it also defines the ability of the firm to absorb losses. There's a few, and I'm going to review this again because I think it is really key to understand how a firm operates, is using debt to magnify both the risk and expected return of what the firm does. So you got to look at both sides of it. Oftentimes we find that the result of debt, the more debt, the higher the stock beta is. So we see more volatility in the stock because of the amount of debt if it's excessive. Substituting long-term debt for equity, it expands the expected return of shareholders, as well as the standard deviation or the dispersion of those expected returns. So we want to see it being used effectively. And the level of expected returns is measured by earnings per share or return on equity. Return on equity is probably a little better measurement than earnings per share because you can do some things to make that number grow when nothing is there. Raising new capital. Companies need to raise money. Working capital, the business is growing. They need to add working capital. Purchase of property, plant, and equipment, acquisitions. But what we have seen in the past week is companies in bankruptcy, such as Hertz, trying to issue stock to get themselves out of debt. So I have to add that one in. And sometimes companies want to change their capital structure because they see something that is out there in the market, like today, very low interest rate, and it may make sense based on these low interest rates to actually add a little bit more debt on because debt is so much cheaper. So there's readily availability of the debt, the cash, and it can return. Now it can work the other way just as clearly. So it's a mix. Capital structure is that mix of debt and equity that a company uses to provide funding for the future. Takes into account leverage. Both have costs. Debt and equity both have costs. Equity is not free. There's tax implications for both the debtor and the creditor, shareholder and company. Then we have, do you pay dividends? Do you do stock buybacks? All of this comes into play with the capital structure. Let's take a moment on the tax treatment. Interest on debt is deductible for tax purposes. Therefore, if you're looking at a nominal interest rate, you have to look at what the after-tax impact of that is. Okay? So interest is deductible for tax purposes, reduces taxable income. So using a very simple example, if you have a 30% tax rate, we all know it's 21, the effective cost of debt, say the interest rate is 10%, would have an after-tax cost to the firm of 7. So the impact is not 10, but is 7. Okay? So when we're doing some of the analytics, especially in determining weighted average cost of capital, we take this into account. Dividends paid on equity is not tax deductible. So if I pay a dividend payment, I don't get the benefit. So if I'm paying out to my shareholders, that is not a deduction. Where if it was debt, it would be a deduction. They're the taxed earnings of the company, which are taxed when they receive. When we look at company earnings, the net income or loss can be retained by the company. There's no rules or anything that says you have to pay out earnings, but they can be. And retained earnings is a way for the company to generate internal capital. You saw that in cash flow and liquidity. It's internal capital can be generated. And we always want to keep coming back to what is the cash. Some shareholders may or may not have an expectation of dividends. We have some stocks that are dividend paying stocks and we expect it because it's part of the return. And on many companies, the dividend is an expectation. But in other companies that are growing rapidly and need capital, they will retain a lot more. We measure the dividend payout rate. It's a percentage of the earnings paid out in the form of dividends. So if you think about this for a second, if a company has $100 of income and they pay out a 20% dividend, $20, there's still $80 that they're retaining. Now, if you have a company that's making $100 and they pay out $90, if there is a reduction in income, they're going to have to cut that dividend. So again, we're seeing that today. We're seeing some very strong companies continue to pay dividends, but we're seeing an awful lot who've reduced the dividend because they expect their earnings to go down. And they may have a policy if we'd like to retain more earnings for growth so we don't have to go and borrow. Okay? It can be a stronger company. Then there is the buyback of stock. Many U.S. companies have accumulated massive amounts of cash on their balance sheet. Some, not everybody. Okay, we can look at Apple. They have a ton of cash. Okay, but then we can look at the airlines today who have almost no cash at all. So there's a lot of variation amongst companies. There's really a good discussion out there on acquisition, big companies that have a lot of cash acquiring smaller companies. It's worth a read. And they did this back, a lot of companies started doing this back in 2008. Some were smart. Okay, they didn't make large investments, they reduced debt. And a lot of these companies are what we'll say have fortress balance sheet, which you heard me talk about previously. And others were just buying back stock. And sometimes you buy back stock for a couple reasons. Is you don't see any investment opportunities for what you have at an appropriate risk profile. Purchase of company stock is often done when it's, quote, cheap. The company believe it's undervalued based on what they see the earnings to be. It's cheap. Company can increase its leverage by doing this and thus magnifying the return to shareholders. And that results in increasing ROE for remaining shareholders. So when we evaluate capital, there's a couple things we do. The first thing you have to do is identify what is the capital structure today. And that includes, so we start with what's long-term debt and capitalized leases, okay, and equity. You put them together and that is your total capital. So then that's the first step in that process. The second is to determine the relationship and extent of leverage. What is the relationship between the debt and the equity? How deep is it? We look at a couple of things. Debt to equity, leverage was one measure of leverage. The leverage ratio, total assets to equity. You're highly leveraged. This is a term that is used quite a bit, and today, again, this whole environment that we're in makes this more meaningful. A debt to equity ratio of 1 means that half the firm's capital is provided by equity and half by debt. The lower the ratio, the more provided by equity. Now, that would indicate that it is a very strong company from an equity perspective, but then the question comes up, can they leverage more to increase the return on equity? On the other hand, the higher the ratio, the more leveraged a company is, which means there's more risk to both the debt and equity holders. So that means you need to evaluate the capacity to serve the debt. A highly leveraged company has inherently more risk, but it also needs to be reviewed within the context of its growth and future earnings. So a company can be highly leveraged, but if they're growing very rapidly and the expectation of future earnings are there, it may make a lot of sense to have that higher leverage. So that is the key part on that. Future borrowing capacity. What we just talked about here in this is on balance sheet. So this is the debt and capitalized leases on the balance sheet. And not all opportunities to fund growth is on the balance sheet. We'll call that off balance sheet. A lot of companies have arranged credit facilities to obtain additional capital. They don't always have it on their books. It's available to them. And we're going to talk about that in the next video. So take a minute, walk through this. You might want to do this part of your project. And then in the second half, we'll actually look at how this is applied.